Welcome back, everyone, to another Battle of the Funds episode where I compare investment options and ultimately select one for my portfolio. If you're interested in investments paying you over 8% without any net asset value erosion, then hit that subscribe button and stick around to see which energy sector fund I invest in right here in the red zone. In my red zone portfolio, I've allocated 40% to an income investing strategy with 6% of the total portfolio set aside for investments in the energy sector. In a previous episode, I reviewed master limited partnerships and summarized some of the recent history of the sector. An additional historical footnote is that corporate taxes were lowered from 35% to 21% due to the passage of the Tax Cuts and Jobs Act in 2017. This was a catalyst for several midstream companies to convert from a MLP structure to a C corporation, which affects both tax treatment and price appreciation. Here's a recap of the funds that I briefly covered in that previous episode. Now, although these funds represent the midstream energy space, we also have a fund option I'm going to add to the comparison today that will include big oil, which is the Adams Natural Resources Fund, ticker symbol PEO. I'm going to first compare the closed end funds against each other, then the ETFs, and ultimately pick investments to add. So, starting with the closed end funds, and we'll start with the income or yield, EMO is our highest yielder, with PEO slightly behind, followed by NML, and finally KYN. Now, unlike closed end funds we've reviewed in the past on this channel, this sector has experienced shocks that forced all of these funds to cut their dividends. From the dividend peaks to today, both NML and EMO are down roughly 45%, with KYN's dividend lower by 63% from its peak. We know the history of the sector, and I have a more positive forward outlook at this point, but KYN is lagging in the overall recovery, even though it increased its distribution in January of 2024. Because it's a laggard here and currently has the lowest yield of the group, I'm eliminating KYN for further consideration. PEO's history, as it's more diversified across the entire oil industry but weighted toward hydrocarbon extraction, is a little different. PEO has paid out numerous special dividends in its history, which makes it a little bit harder to decipher those increases or cuts. It also seemed historically to pay three small quarterly dividends, with an outsized dividend generally at the end of the year that was often made larger due to the fund's tendency to pay those special dividends. That changed this year as recent policy has made the distributions much more consistent, as overall the fund is targeted to pay out 8% of the fund's net asset value and roughly 2% each quarter. As energy in general has lagged nearly every other sector this year, we do see a slight decline in the distribution this year, and I personally expect special dividends to either be less frequent or at least lower in amount going forward. So after round one, our overall scorecard with KYN eliminated. Next, we'll take a look at total return. And although we aren't overly concerned here, we want to see if there's signs of NAV erosion. EMO leads in various shorter time periods until we go out to a 10-year view, where we see what happened in 2020. EMO performed worse than NML during this time period, primarily because it has higher leverage. Additionally, NML had a weighting to midstream companies structured as C corporations, which, if for nothing else, means the fund had a higher proportion of assets that were more likely to be held in other more diversified ETFs due to the similar tax treatment. During the recovery, that allowed those prices of those underlying C corporation holdings to rise more rapidly. As I'm in the pre retirement red zone, stability is more critical than chasing outsized performance, and therefore I'm eliminating EMO due to its higher leverage, which showed its downside in 2020, leading to lagging 10-year total returns, even though it beats NML and PEO in shorter time frames. PEO also remains as it uses only a very small amount of leverage of less than 1%. Now, we'll take a look at the holdings a little bit more. NML is a mix of midstream companies structured as both MLPs and C Corps, while PEO holds oil titans Exxon and Chevron, while also holding midstream companies like Kinder Morgan in its top 10. So the question here is, why are we buying the asset? First, we want it to pay us as we're looking for a stable source of income in retirement and starting to transition our portfolios to income producers. Second, we want diversification amongst our portfolio in the form of weak correlation, lower beta, or even different holdings in the same sector. SCHD, which I have a large holding in the dividend growth portion of my portfolio, increased its energy holdings during its annual fund reconstitution in March of this year. And although these holdings are top notch, the energy sector, as I mentioned earlier, has been the worst performing sector in 2025. So the question is, do I want to hold these same assets in a closed end wrapper and generate a yield of 8%, but simultaneously weighting my portfolio even more to hydrocarbon producers? For me, at least at this particular point in time, the answer is no. Therefore, I'm eliminating PEO from consideration. It's a great fund, nothing wrong with it. It just has some significant overlap with the fund I already hold. Now let's take a look at the ETFs. I'm going to start with total return simply so we can see a leveraged fund, AMZA, and how it does over 10 years compared to the other options. And we see the same performance challenge post 2020, primarily due to the greater loss it experienced, which is attributed to its use of leverage. Now, I'm not totally against leverage. I hold PFFA, which is a leveraged preferred equity ETF, which, if you want to take a look at the comparison of preferred equity funds that I did, you can do so in this video. But less leverage, particularly in this sector as a red zone investor seeking stability, seems like less is more historically. So AMZA is out for me. If we look at dividend yield, AMLP is paying over 8%, while MLPX is paying under 5%. That 4.87% from MLPX is far below the target yield of 8% for the income portion of my portfolio. However, before we throw it out, let's look a little deeper. In terms of dividend history since its inception of 2014, MLPX's dividend has been variable, but it has trended up and to the right. If you recall, when we looked at our closed end funds, we saw massive dividend cuts all occur at around the same time in roughly the late 2015 and early 2016 periods. And AMLP didn't avoid this situation either. In fact, AMLP is still distributing 50% less than it did during its peak, while MLPX is distributing 67% more from inception. MLPX's dividend compound annual growth rate, or CAGR, for the 10 and 5-year periods is around 5.5%, with a 3-year of almost 11%. AMLP, on the other hand, has a 3-year slightly lower at 10% and 5-year at around 4.5%. But when we go 10 years out, we see a negative dividend compound annual growth rate of 4%, which reflects both the early 2020 and the early 2016 periods. Although AMLP has its weaknesses, I'm actually going to eliminate MLPX as the starting yield is just too low and therefore does not fit the income portion of my portfolio. However, I'm going to keep it on my watch list and as a hold for a potential future part of my dividend growth portion of my portfolio, as even with SCHD's high exposure to the energy sector, due to SCHD's large cap nature, none of the holdings are the same with MLPX. Starting out comparing NML and AMLP, we'll look at total return. Very similar. Dividend yield, similar. Dividend history, similar in terms of dividend recovery. Now, you can't really compare dividend CAGRs here, as NML's last dividend increase was in 2022, which is providing the large 3-year CAGR we see here, and NML has a managed distribution policy to pay the same amount monthly. Normally, I would go with an ETF over a closed end fund here. Like, why add the complexity of a closed end setup and leverage when you don't have to in order to get the same yield? However, AMLP's lack of C corporation midstream companies may impact its longer term growth ability. We saw that when we compared it to MLPX, and in general, if we were just looking at ETFs, we might conclude that MLPX is a better investment for a younger investor seeking both exposure to the sector and capital appreciation, while AMLP could be better for a retiree due to the difference in starting yield and shorter investing time horizon. But when we compare similar yields between AMLP and NML, AMLP's only 15 holdings are lacking in diversification for me, compared with NML's, which include C corporations. In summary, I'm going with the Neuberger Berman Energy Infrastructure and Income Fund, ticker symbol NML, as my next addition to my portfolio, primarily because of its current yield of over 8%, its slightly better recovery from dividend cuts in 2016 and 2020, its slightly lower leverage when compared to its competitors, and the fact that it's diversified beyond just the MLP structure and has some natural gas producers as well. I'm keeping an eye on MLPX as a potential addition to the dividend growth portion of my portfolio as well. So, which midstream fund do you invest in and why? Feel free to leave a comment and let the community know. If you're interested in other income producing funds, check out this comparison that I did on utility funds, which, granted, many are not pure utility plays and contain midstream holdings in addition to the utilities. So, if you like a simpler portfolio, in this case defined as less funds, one of those may be right for you and eliminate the need to look at multiple sectors. Until then, I'll see you next time right here in the red zone.